At 3 p.m. on April 21st, the official website of the People's Bank of China dropped a bombshell. The People's Bank of China, the National Financial Regulatory Administration, the State Administration of Foreign Exchange, and the Shanghai Municipal People's Government jointly issued the action plan for further improving the facilitation of cross-border financial services in the Shanghai International Financial Center. In simple terms, this action plan is like giving a super boost to the international free trade accounts. It aims to expand the usage scenarios of the Chinese yuan and enhance the convenience of cross-border yuan transactions. The core support of this plan is the Cross-Border Interbank Payment System (CIPS) for the Chinese yuan. The plan also particularly emphasizes the need to enhance the functions of CIPS and expand its global network coverage. With the global tariff war in full swing, China's sudden introduction of this action plan at this moment clearly indicates its intention to promote the upgrading and evolution of the Chinese yuan, propelling it towards greater internationalization. This measure is bound to attract more global funds to participate in yuan settlement, directly challenging the Society for Worldwide Interbank Financial Telecommunication (SWIFT), which dominates the international trade settlement system. Why does challenging SWIFT amount to declaring war on the US dollar's hegemony? It's important to understand that the US dollar's status as the world currency relies on two major pillars: its dominant position in international trade settlement and its role as the core of global foreign exchange reserves. The reason why countries around the world regard the US dollar as the core asset of their foreign exchange reserves is precisely because of its extensive use in international trade settlement. Previously, when Chinese enterprises conducted cross-border transactions and used the US dollar for settlement, they had to go through SWIFT. But now, with the Chinese yuan, they can directly use CIPS. The same applies to foreign enterprises. Therefore, China's proposal to enhance the global network coverage of CIPS is clearly aimed at reducing the risk of being choked by the US dollar and building a solid financial infrastructure in advance for the potential decoupling of trade. In fact, China has been preparing for this moment for a long time. CIPS is not a recent development. Its construction began on April 12, 2012, and it was officially launched on October 8, 2015. By March 26, 2018, the second phase of the CIPS system was successfully put into trial operation, achieving full coverage of financial markets in all time zones around the world and supporting global payment and financial market operations. Since then, CIPS has been steadily advancing its global layout. Although the progress may seem a bit slow, its potential for growth is enormous. By the end of 2019, the CIPS system had 33 direct participants and 903 indirect participants, representing an increase of 74% and 413% respectively compared to its initial launch. It covered more than 3,000 bank legal entities in 94 countries and regions around the world. However, by the end of February 2025, the number of direct participants in the CIPS system had increased to 169, and the number of indirect participants reached 1,478, covering 119 countries and regions globally. Through more than 4,800 legal bank entities, it serves customers in 185 countries and regions around the world. Now, with the official action plan openly proposing to enhance the coverage of CIPS, it indicates that the Chinese yuan is ready to enter the fast lane of internationalization. Moreover, in the high-level planning, the internationalization of the Chinese yuan is an inevitable trend. The current timing is truly ideal, with all favorable conditions in place. Looking back, we can see that China has been quietly laying the groundwork for the internationalization of the Chinese yuan, waiting for the right moment to promote the use of CIPS in more financial institutions around the world. Previously, China-US trade relations were relatively good. Even after 2018, when relations cooled significantly, they hadn't completely broken down. At that time, China could still continue to enjoy the dividends of globalization. However, after Trump took office this year, his series of actions have signaled that China-US trade has entered a stage of substantial decoupling. The international free trade system established after World War II has been severely damaged by the Trump administration. Even if relations between the two countries ease in the future, there will be limited room for maneuver, as the issues involved are matters of fundamental interests. Nevertheless, global trade must go on. Many countries dare not easily offend either China or the United States. Even the US's staunch allies, such as the European Union and Japan, dare not easily offend China in terms of trade, let alone other countries. Why? Because without China's supply chain, they simply cannot function properly. In other words, many countries are trying to please both sides. At this moment, they neither want to jump off the US ship directly nor dare to completely ignore the rising power of China. It should be noted that China is now the main trading partner of more than 150 countries and regions, and its total volume of goods trade has ranked first in the world for 7 consecutive years. China is also the largest trading partner of the Association of Southeast Asian Nations (ASEAN). In 2024, the volume of goods trade between China and ASEAN reached 6.99 trillion yuan, far exceeding China's trade volume with the European Union and the United States. In 2023, China actually utilized foreign direct investment of $163.3 billion, firmly ranking as the second largest recipient of foreign capital in the world. In the same year, China's outbound direct investment flow was $177.9 billion, accounting for 11.4% of the global share, and it has ranked among the top 3 in the world for 12 consecutive years. In the past, countries around the world may not have considered the potential impact on the stability of their trade, but now they have to seriously think about this issue. And at this moment, only CIPS can completely bypass the US dollar settlement system, leaving the United States with no means to exercise its extraterritorial jurisdiction. Since Trump has created such a favorable opportunity for us, the introduction of this action plan is a natural step. China was previously fully prepared, just waiting for the right wind to blow. Now that the wind has arrived, even those countries that were previously hesitant have to consider how to maintain stable trade cooperation with China under these tariff barriers. After all, in the face of survival, no one will act foolishly. Why is this considered an excellent opportunity? We can get a clearer picture by looking at the dynamics of financial capital. The current situation clearly shows that a large amount of global financial capital is starting to flee the US market. Why is this happening? The global tariff war has made global financial capital increasingly distrustful of US dollar assets. Although the US stock market soared on the 22nd local time, the overnight US stocks on April 21st plunged sharply. The Dow Jones Industrial Average dropped by 2.48%, the Nasdaq Composite Index fell by 2.55%, and the S&P 500 declined by 2.36%. The reason behind this was that Trump threatened to remove Federal Reserve Chairman Jerome Powell from his position. The Federal Reserve, as the central bank of the United States, although not owned by the US government, controls the global circulation of US dollars. Its every move can directly trigger fluctuations in the global financial market. The monetary policies of central banks around the world almost always have to keep an eye on the Federal Reserve's plans. Trump's statement about removing Powell from office against the backdrop of the US economy already being shadowed by recession due to his tariff policies is like adding insult to injury for the already jittery US dollar capital. Trump's unbridled intimidation will only cause more capital to flow out of the US market. So, we witnessed that on April 21st, the US dollar index broke below the 99 mark right at the start of trading. Then, it fluctuated weekly within the range of 98 to 99. By 3:58 p.m. on the same day, the US dollar index directly broke below the 98 mark, reaching a new low since March 2022. It even touched a low of 97.92 during the intraday trading, with a daily decline of 1.46%. The yields of 10-year and 30-year US Treasury bonds also soared again on that day. The yield of the 10-year US Treasury bond reached a high of 4.418% and closed at 4.417%, with a yield increase of 1.94%. The yield of the 30-year US Treasury bond reached a high of 4.922%, approaching the 5% mark, and finally closed at 4.9199%, with a yield increase of 2.3%. The US dollar also depreciated rapidly against some non-US currencies. Its exchange rate against the Swiss franc dropped to a 10-year low, against the euro to a low since November 2021, and against the British pound, Japanese yen, and Australian dollar to multi-month lows. It can be said that the direct result of Trump's threat to the Federal Reserve this time is that the US stock market, US Treasury bonds, and the US dollar exchange rate once again experienced the so-called triple kill situation. As a safe haven asset, gold has been frantically snapped up by the market in the past 2 days. Yesterday, the spot gold price broke through the $3,500 per ounce mark, reaching an all-time high, with an intraday increase of over 2%. Since the beginning of this month, it has increased by over 12%, and since the beginning of this year, it has increased by more than 30%. The conflict between the White House and the Federal Reserve has now been completely laid bare. In order to create a low-interest environment for US Treasury bonds, Trump is willing to artificially create economic recession and trade chaos and use this to put pressure on the Federal Reserve, demanding that Powell cut interest rates. However, it seems that the Federal Reserve is not willing to comply at all. As early as April 17th, Trump said that Powell was playing politics and that the sooner he left, the better. He even threatened that if he wanted Powell to leave, Powell would have to go very soon. The next day, National Economic Council Director Larry Kudlow also stated that Trump and his team would continue to study this matter. The day before being criticized by Trump, Powell had already publicly stated that the Federal Reserve would not succumb to political pressure. Powell believed that the Trump administration's recent tariff policies had complicated the economic situation in the United States, and the Federal Reserve needed to focus on combating inflation. Powell made it clear that Trump's tariff policies would definitely trigger inflation in the United States. If interest rates were cut at this time, it would only push up inflation in the United States more quickly, leaving even less room for the US monetary authority's future policies. To be honest, although it is not entirely impossible for Trump to remove Powell from his position, it is extremely difficult from a legal perspective in the United States. However, this does not affect Trump's consistent style of extreme pressure tactics. In his 1987 book The Art of the Deal, Trump mentioned the 4 steps of his business approach. First, setting astonishing goals. Second, vigorously promoting and creating momentum. Third, being indecisive in decision-making. And fourth, achieving tangible results. Now, everyone should be quite familiar with these 4 steps. Trump is clearly using his wavering policies to manipulate the sentiment of the global market. One day he does this, and the next day he does that. In short, he wants to create some commotion. This time, he even made such a wild statement about removing Powell from office. Although there are some passive factors involved, there are also some proactive elements on his part. The result is that he continuously exacerbates the future uncertainty. In such a situation, who would dare to bet all their assets on the United States? The US dollar index has plummeted all the way from 110, and there is still no obvious sign of it stopping the decline and recovering. This clearly shows that capital is voting with its feet. In the past, when the US stock market crashed, US Treasury bonds could still be the first choice for safe haven funds. But this time, it has completely broken the previous pattern, indicating that capital is already looking for new outlets. Although we cannot say that the attractiveness of the US dollar has been completely destroyed, at least its foundation has been shaken. Then, the Chinese yuan, which is anchored to China's huge industrial system and production capacity, naturally has the opportunity to become a new choice for capital. Objectively speaking, such an opportunity is extremely rare. So, it can be said that the United States is pushing itself towards a dead end, and no one can stop it. This is the law. As a global reserve currency, the US dollar accounted for 60% of the share in 2020. However, by the end of last year, it had dropped to 57.4%. If Trump continues to act like this, the share of the US dollar as a reserve currency will definitely decline further. At the same time, in 2020, the US dollar's share in the SWIFT international settlement system was 50.9%, but by the end of last year, it had dropped to 46.7%. In the first quarter of this year, the share continued to decline to 45%, and this trend is likely to continue. Although the yuan's share in SWIFT was only 3.89% by the end of last year, when combined with the part of CIPS, the yuan's share in global trade payments has reached 4.5%. Don't underestimate this 4.5%. We have always been in the SWIFT system. Once there are more problems with the US dollar, this proportion will surely soar rapidly because CIPS has already started to show its strength. Now, at least within the BRICS system, the yuan's reserve amount has reached as high as 70%, with Russia accounting for the vast majority of it. After the Russia-Ukraine war, Russia was kicked out of the SWIFT system, so it can only use the yuan as a reserve currency instead of the US dollar. It can be seen that the internationalization of the yuan is an inevitable trend. The biggest advantage here is China's huge volume in physical trade, which provides natural convenience for CIPS. Once CIPS is deeply integrated into the trade system, ultimately, the yuan will influence and even gain the pricing power of commodities. As long as China masters the pricing power of physical trade, the next step will be to obtain the pricing power of financial assets. So, don't think that CIPS is just a simple settlement system. Every step taken by the country is a masterstroke. Behind CIPS is the country's hope of, as a major and even powerful industrial country, obtaining pricing power at both ends of the industrial chain and value chain. Only in this way can China achieve another takeoff, and national rejuvenation will have a real economic and financial foundation. Now, everything has been paid for the internationalization of the yuan to enter the fast lane. Take CIPS itself as an example. Its payment efficiency is much higher than that of SWIFT, and the handling fee is only 1/10 of SWIFT's. For the huge and frequent international trade volume, the handling fees saved are by no means a small amount. The yuan's powerful counterattack has already begun. When the US dollar index keeps plummeting and US dollar assets are being sold off in large quantities, China is taking the opportunity to promote the internationalization of the yuan. This move is truly brilliant. At this moment, CIPS is like a powerful weapon. It not only ends the risk of being choked by the US dollar, but also promotes the internationalization of the yuan and paves the way for China to obtain pricing power in both the real and virtual economies in the future. In this world, only a well-planned and inevitable strategy is invincible.